I call this Altoona City Council meeting to order Monday, March 8th, 2021. We'll now have a moment of silent prayer. Please stand for the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Linda, would you take the roll call, please?
Vice Mayor Butterbaugh.
Here.
Councilman Kashadi.
Here.
Councilman Carper.
Here.
Councilman Ickes.
Here.
Councilwoman Jordan is absent. Councilman Kelly.
Here.
Mayor Pacifico.
Here. We have a presentation on the agenda tonight on the police pension investment policy statement, and joining us from Marquette Associates is Pat Wing. Pat?
All right, great. Well, good morning. Good evening, everyone. It's nice to see you all. Before we jump into the book, just let me spend a quick minute telling you a little bit more about myself and the firm. So I work with Marquette Associates. We're a firm headquartered out of Chicago, in a satellite office in Westchester, Pennsylvania, Chester County, about 45 minutes west of Philadelphia. With the firm, I'm a consultant, managing partner. In our office, we work predominantly with public funds, Pennsylvania public funds. We serve about 50 clients, about 40 of those are public funds, and about 30 are various counties, municipalities, and municipal authorities within the Commonwealth. So it's really our core competency, our bread and butter, if you will. So with all that said, let's hop into the book, spend a few minutes talking about the investment policy statement. So if you hop behind that cover page and look at page 2 there, as far as the investment policy statement is concerned, you see that first blurb at the top there, but what this really is the roadmap for the funds, the various pension funds. And as you all well might know, the funds do not have an investment policy statement right now. So one of the first things we wanted to tackle at this new relationship is getting one in place, because it is best practice. When you think about the policy statement at a very high level, you're trying to answer a few key questions. Who's responsible for what? What are we trying to do? How are we trying to get to where we need to be? And why? So when you think about those things, and you can see these bottom bullets here, what the IPS should cover at a minimum, all those are defined in the statement. A lot of the language is pretty commonplace for most institutional investors, but the key dynamics are really bolded up at the bottom there, related to objectives, risk tolerance, and asset allocation. So those are items that are really unique to each investor. So we spent some time with the other two boards, really walking through the presentation that you'll see here today, really discussing our thoughts about what's an appropriate asset allocation for the fund. Again, how can we get to where we need to be? And specifically talking around those asset allocations, the asset classes for consideration. So with that said, if you hop to page 3, what we're showing on this page is the return outlook for a few key asset classes. So historically, most investors have used two asset classes, really equities and fixed income, to get to where they need to be. And historically, you could do that. Equities have returned in the neighborhood of, say, 8 to 10% historically, and fixed income's been about 4 to 5%. So if you're trying to hit a 7.25%, 7.5% assumed rate of return, you just really needed those two asset classes. However, if you look at that table, specifically those top 2 rows, what we're showing there in the middle column, where you see MAI, that's Marquette Associates Incorporated, are 10-year return projections for those two asset classes, and then to the right of there, a third-party 10-year return. So we also wanted to show you not just what we're thinking, but what our competitors and peers are thinking out there for the long-term projections. And when you look at those 2 rows, you can see really in the neighborhood of 7%, so below the historical averages, and we are in line with most of our peers. And the reason behind that is equities are somewhat overvalued these days, given the strong run-up that we've seen. And generally, when you buy an asset class that's trading a little bit above its average valuation, then moving forward, you can more likely than not expect a below average return, so something below that 8 to 10%. But the key headwind, as I boxed up here, is really around fixed income. So you can see those 10-year return projections south of 2%. And the reason behind that, as I'm sure you're all well aware of, is low interest rates. So in an environment where interest rates are very high, you're receiving a lot of income in fixed income, which helps your return. But where we stand today, interest rates are exceptionally low, meaning moving forward, returns from fixed income are going to be low. So when you have these two major asset classes which are poised to generate below average returns, that's really a tough hand, really, that all investors have been dealt to try and get to where they need to be. So with that headwind, many investors are considering other asset classes, say outside equities and fixed income. And you can see those below here, namely core real estate and infrastructure. So when we think about asset classes outside of equities and fixed income that investors can consider, there's a myriad of investment choices, between these two asset classes, other more exotic things like hedge funds and private equities. But we're big believers to focus on simplicity, right? Things that are low cost, transparent, less complex, more easily digestible for our clients. And we think core real estate and infrastructure certainly fit that bill. And many of the PA public funds that we work with have allocations to those areas. So with that said, I'd like to spend a few quick minutes talking about core real estate and infrastructure specifically, and at the end we'll wrap things together to look at the return and sort of risk outlook for the total fund level moving forward. So you can see on page 4 how to invest in core real estate and infrastructure. We'll start to the left side. You see core real estate. So you can really do it two main ways. You can invest in a mutual fund. So a mutual fund that buys and sells the stocks in companies that own and operate real estate assets. Or you can do it in a private open-end fund there that I bolded up. So this is a little bit different, where you'd be investing in, say, a private partnership. So you would own shares just like a mutual fund, but in a private partnership. But then that partnership would own the assets directly. So the key difference between a public and private is really around liquidity. So on the public side, you can buy and sell these things on a daily basis. On the private side, the liquidity is a little bit more limited. It's generally on a monthly or quarterly basis. Now, in times when, say, the real estate market is under a little bit of pressure, and we are seeing that today, liquidity can be reduced a little bit. So in other words, investors, if they ask for their money back, might not get it all back in one quarter, might just get a piece of it. And the reason why investors or managers do that is really to protect the investors, all of them within the fund. So say you have a fund of 100 investors or so, but only a couple ask for their money back. There's a cost to do that, right? Maybe to sell an asset, but it's not just borne by those two investors, it's borne by everybody within the fund. So it's really to protect all of the investors and really discourage, say, short-term trading in and out of the fund. Now on the infrastructure side, you can see bolted up is actually the public mutual fund. So that's what we're proposing here. So a mutual fund that buys and sells the stocks of companies that own and operate infrastructure assets. Why we're not proposing the private here is because the minimums to do that are usually quite high, and the funds themselves aren't big enough to access those private investments on the infrastructure side. So with that said, if you could skip ahead to page 5, just want to spend a couple of quick minutes talking about real estate and infrastructure in isolation. So on page 5, you see some nice pictures of the types of properties we're talking about. But to back up for a second, you see at the top core real estate. So when you think about private real estate, core real estate's really the most conservative way to invest in private real estate. So it's not buying a piece of land and then developing that land. It's not buying a building where there's no tenant base and you have to fill up the tenants. It's buying buildings in major markets that are very highly densely populated. These buildings have well-established high-quality tenants, and therefore the rents and the income paid by those tenants, which are funneled back to the investors, are much more stable within the real estate universe. And you can see on those pages a couple of examples, right? So say a industrial building in Staten Island, office building in Chicago, New York, multifamily apartment in DC, San Diego, things of that nature. Again, sort of premier assets in very high quality markets. On page 6, from a risk return perspective, this is a comparison historically of core real estate all the way to the left there. You see in the gray diamond, and then the various other asset classes within the fund right now, namely fixed income below that. And then to the right, U.S. equities in blue, non-U.S. equities in red, and then U.S. REITs, or a public mutual fund, there in darker gray. So in isolation, you think, if we're going to invest in real estate, why not just do U.S. REITs, right? The return is higher than core real estate over the long term, but for that higher return, you tolerate more volatility because they're traded on an exchange. Now, if you compare that with core real estate over all the way to the left, the return's somewhere in between fixed income and equities, but it has much lower levels of volatility. So when we think about the total fund and putting the pieces together, putting an asset class that has much lower levels of volatility relative to what you already have can provide more downside protection, more diversification for the total fund as a whole. Any questions or comments from council or anyone else before we move on? Okay. So on page 7, spend a couple of minutes talking about infrastructure. So at a high level, you can see the takeaway right there bolted up. What are we talking about here? The assets and networks necessary to operate a society, right? For social, economic, industrial growth and development. So the assets themselves, you can see they share some key common attributes down there. So number one, they provide an essential service to society. So many of the things we take for granted in our daily lives, right? Transportation, our cell phones, electricity, water, things of that nature. That's all infrastructure within the economy. If you look at the second bullet point, these owners and operators of the assets tend to operate somewhat of a monopoly at times because there's a huge fixed cost to build a new asset, right? Think about building a new airport or a new toll road or a new broadcast tower. It's very, very costly to do, so there tends not to be a lot of competition for the players already in the space. And given that, there tends to be some regulatory oversight because if you have one or two companies operating in a specific segment and they're operating in somewhat of a monopoly, there's going to be regulation of that, rightfully so. And then finally, stable and predictable cash flows. This really circles back to the first part, the essential service, the things that we take for granted. If the economy's poor, we're going to continue to pay our electricity bills, our water bills, our cell phone bills, when maybe we put off that new home purchase, that new car purchase. Might be sacrilege to some, but that Starbucks purchase every day, right? Those things may go away while we'll continue to pay that electricity bill, the water bill, the cell phone bill. So given the demand for those services tend to be steadier than other segments of the economy, the cash flows tend to be more stable and predictable as well. So if you look on page 8, what exactly are we talking about within infrastructure? Really broken down to 3 main sectors. You can see as you work your way from left to right, transportation, energy and utility, and communications. So transportation, you see the examples below there, airports, bridges, rails, roads. Those, within infrastructure themselves are probably a little bit more of the more aggressive segments because if the economy does turn down, we might put off that vacation. We might take that longer route to wherever we're going to avoid those toll roads. But then if you look in the middle, energy and utility, now you start to get to those more conservative, more stable cash flows, right? Again, we're going to keep paying our electricity bill, our water bill, our gas bill. And then finally, to the right, communications. This is what's called contracted assets. So what happens here is somebody will own these assets that you see listed and have a contract with an operator, somebody or a company who's using that asset for their business. But those cash flows aren't determined by how much people use them. It's well defined in advance, usually between 10 and 15 years. There'll be a contract between who owns it and who operates it. And that usually grows in line with inflation as well. So those cash flows are very stable for that part of the infrastructure market. So we skip ahead to page 9 before we switch gears and talk about the total portfolio level. Again, a similar breakdown from risk and return. Here we're comparing those asset classes that we showed before, but the new one in the middle, right to the southwest of U.S. equities, you see listed infrastructure. So again, this is a listed mutual fund approach. What's notable about this is really two things. Number one, the listed infrastructure is really global, so these are U.S. and non-U.S. companies. But even though they share both from each region, the return is actually much closer to U.S. equities rather than it being in between U.S. and non-U.S. And then also notably, the risk is lower than U.S. and non-U.S. equities as well, really owing to those essential services, stable cash flows that these assets generate over time. So if you look at page 10, what we thought would be helpful as part of these discussions is look at a few different options here. So what you see in the current, even though, as I mentioned, there's no investment policy in place right now, the current reports done by the previous advisor note an investment objectives index. So that's what we're using here for a reference. And you can see the pie chart and then how it breaks down across those asset classes there. Basically 55% equities, 45% fixed income. Then as you work your way from right to left there, the difference between portfolio A and the current is we're still talking about equities and fixed income, but moving more assets out of fixed income into equities, just given those challenging headwinds from fixed income that I noted earlier on. And then B, C, and D are incorporating those other two asset classes, where B incorporates a slight allocation of real estate sourced from fixed income. Infrastructure, similar, just a source from fixed income in portfolio C. And then D finally has a small allocation to both of those asset classes, again, sourced from fixed income. So with that in mind, if you turn to page 11 as we wrap up here, we talk about these asset classes, the challenges from equities and fixed income, but then again at the total portfolio level, what are we looking like from not just a base case scenario moving forward, but also the range of outcomes, say the best case and the worst case, because I can tell you that over these 10 years, the base case isn't going to come out to what we're showing here, right? That's what the base case is, but markets are cyclical, very uncertain, so we're concerned about the range of outcomes. So if we focus on that table up top and then we'll move into the chart below, you see that current, again, that 55-45, the base case outlook over the next 10 years is a return just north of 5%. Because it's very conservative, right? You have almost half of the fund in fixed income where the return outlook is very, very poor. So importantly, even though you're making money in that environment of just north of 5%, it's well south of the assumed rate of return. So from the city's perspective, how that impacts you is, even though, again, you're making money, the assumed rate of return is 7.25%, but you're not making as much money as the actuary is assuming. Therefore, the funded ratio would actually come down over time, which has obvious implications from an MMO and a budgetary perspective. You work your way from left to right there at portfolio A, you have an uptick in return expectations, moving money out of fixed income into equities. Along with that, if you'll notice below in that middle bar, the volatility or risk, that goes up a little bit as well. Moving money out of a more conservative asset class into a higher returning but slightly more volatile asset class is going to generate a higher return but a slight uptick in risk. But then if you look B, C, and D, you also have those upticks in returns from left to right, but from a risk perspective, not all that much changes. And the reason behind that is you no longer have just two assets in your portfolio, right? You don't have two assets where you can sell high and buy low. You're giving yourselves other opportunities to do that, selling high and buying low with 3 or 4 asset classes. And over time, that can increase your return expectations, as we saw here, or it can also protect you on the downside. And more to that point, if you look at the chart below, what we're showing here is not just the base case, but again, the range of outcomes. So this is what's called a Monte Carlo simulation, essentially thousands of potential outcomes over the next 10 years and where they fall along this return distribution, which you can see on the bottom, working your way from left to right, from -5 all the way up to 15%. So the key takeaway here is you look at that dark blue line, that's the current, right? So many of those observations fall below the black line, which is your target rate of return. And I talked about the dynamics of that just a minute ago. Even though you're making money, if it's coming in below that target, technically that's an actuarial loss and results in lower funded ratios. Now, if you look again at the base case, that would be higher introducing these other asset classes or making changes, but also a higher upside. So if you look to the right of that black line, you can see that dark blue line really falls off a cliff there because there's so much in fixed income, whereas those other lines have more observations above that target rate of return. So similar base case, similar upside, but then when we think about worst case, if you look to the left of that chart, really where those lines fall between 0% and -5%, there's really no difference. So it's all about probabilities, right? In investing, there are no certainties, it's probabilities. And how can we shift them in our favor? So what this chart is telling us is essentially the worst case scenario, or the floor, is essentially the same. The base case is a little bit higher, and then the upside is higher as well. So the floor or the worst case doesn't change, but those two other ones are more in the fund's favor. So with all that said, let me pause. Happy to answer any other questions or comments. I have a big appendix section here, but wasn't planning on delving into that unless there were any specific questions around that.
Some general questions for a lay person like me. So, and some of this, Ken, you may have to jump in on some of this if you don't mind.
Okay.
Assumptions. You make an assumption as to this is our targeted rate of return. So for this pension, any of our pensions, how is that assumption determined?
The assumed rate of return?
Mm-hmm.
That would be, I didn't mean to scoop you there, Ken.
Yeah,
At the end of the day, it's us. I mean, the actuary we try to work collaboratively with, and we're in a situation where each pension fund has a different actuary, but I think it's, the trend has been, I think Pat can speak to this, that historically there are public pensions, it's between 7.5% and 8%, and the trend that we've seen over the last decade is those rates of returns have lowered as people have sort of settled into the reality that you're not going to make those kinds of returns without incredibly risky investments. So I think the trend is to get it to 7 or 6, 7, 5, 6, 5. But ultimately, we're the ones that make the determination. So each of the pension boards has it within their authority to lower our expected rate of return.
Okay, and then Ken, this may be more for you then as well, and that is it the responsibility of the pension board then to develop an investment strategy as to what that mix of investments will be?
Yes, that's
Okay.
correct. So we had previously met with both the fireman board and the non-uniform board and made a similar presentation, and they made a motion to approve Portfolio D for both of those funds.
Okay. Again, I'm a lay person, but I mean, is this really a good time to be getting into real estate?
So it's a
Because I even see you had shopping malls on here, and you had 11,000 store closing announced in 2020, and there's predicting at least another 1,400 store closings in 2021, and it was a 10-year low for mall occupancy rates, and most malls you go to you can almost feel the tumbleweeds rolling down the malls, unfortunately. And you look at, with coronavirus, a lot of our large cities and office space, and is that ever going to return? So is real estate a good investment?
So let me try to tackle that in a couple of
okay,
different.
I know I threw a big one out there.
I took a
Sorry
couple of
about
different
that,
comments.
but-
So Councilman, real estate, or at least the retail segment, you're spot on. That's largely due or a concern generally in, say, what's called Class B, Class C type properties that are in less densely populated cities where you see a lot of turnover in tenants and things of that nature. It's less of a concern. Still one in the more populated cities, major primary markets, highly densely populated areas. That said, within real estate as a whole, we'd say there's a couple of sectors, retail being one, that are facing sort of structural headwinds, office being another. With that one, I think some of the concerns are more overblown by given what's happened recently. Many of those firms have been able to sort of be flexible about the environment because they're working with their existing employee base. As you think about moving forward, it's easy to switch gears and work remotely with a current staff, right? Who knows the culture, who knows the business and things of that nature. But as you see staff turnover, particularly as the economy picks up, as we expected, and I think many others do, when you start to have some turnover and you bring on staff and try to assimilate these people in your business, your culture, and things like that, I think we're going to see much more return to the office space than a lot of us are assuming right now, because again, we have what happened recently in the back of our mind. Now, with all that said, you saw that return projection of just 5.5%, which is below historical standards of say 7 to 8%, but it still falls kind of in that midpoint between fixed income and equities. So from the total portfolio perspective, on a relative basis, it's still generating the sort of returns in between fixed income and equities that it's done historically. So it's still playing a good role, when you put all the pieces together, despite a couple of the headwinds that sectors are facing, as you rightly point out.
Thank you.
You're welcome.
Kind of just to piggyback a little bit off that, has there been given any consideration as far as investing in real estate holdings such as hospitals or long-term care facilities?
So when we make an allocation of real estate, it's a specific manager, and the managers that we're focusing on these days have underweights to retail, have underweights to office sectors, generally overweights to multifamily apartments, say senior housing. We all know the demographic implications in this country, and specifically industrial, because what's eating retail's lunch these days is Amazon, right? Mm-hmm. And all of the industrial buildings and complexes that we see, not all of them, but many of them are Amazon warehouses. So within real estate, sort of one sector's structural headwind is another sector's structural tailwind. So we're trying to focus on those managers that are positioned to take advantage of those tailwinds moving forward, namely the ones that have an overweight to industrial or an overweight to multifamily apartments, senior housing, things of those nature.
Ken, what's the collaboration been like with the actuaries on pensions as far as handling, how are we amortizing our actuarial losses?
Well, we have, three very different relationships with each of the actuaries. The non-uniform Mock and Hopt, which is a fairly well-known name in Pennsylvania in terms of the actuarial space. They do the non-uniform, and the information we've received from them is probably the most like I'm used to seeing. We have, I guess, an admittedly arm's length relationship with the police pension board's actuary, which has been Steve Feaster doing some of the administrative work, and he works for an actuarial firm out of Pittsburgh, but that's been somewhat difficult, and I think we're on kind of we're in a transition phase, because I think my recommendation is to, and we have another firm that does fire, which kind of falls between the two. My recommendation would be pick one actuarial firm to do all three funds, to agree on a format of the report that everyone, including council and the retirees and the employees, can read. And then when we have that, hopefully that one firm that we can agree on, we can take some of the work that we're doing here, because if there's any interest in doing another round of pension reform, all of the analytics for any changes to the structure of the benefit have to be done by the actuary. So we need, if in the collective bargaining process we're going to talk about any changes to the structure of the existing pension, we need to have an actuary on board who can do the analytics to, okay, if you change the vesting period, how does that change the funding ratios? So that's kind of where we are. But that's a hopefully a this year project.
And I appreciate that, and just to my peers here on council, that the discount rate is this assumed rate where you discount future liabilities and obligations to retirees down the road. So the higher the discount rate, technically, the less money you have to put into the plan, But if you don't achieve that, that obviously adversely affects your portfolio and your MMO, et cetera. So my concern comes in for the last decade and 12 years. We've missed the benchmark on the 7.25% assumed rate of return on the largest explosion in equity markets. And now we're in this position where we do have this overvalued equity market still maintaining a 7.25% discount rate, where for every percent that we fail to meet that 7.25%, we double our unfunded liability. I just think that there's, to put this out there, there's just this is going to be a tough obstacle for not only the city of Altoona, but many municipalities to conquer over the next 25, 30 years.
Well, the real world impact is that if we have a projection where we're going to earn less, the minimum municipal obligation, or MMO, goes up. So if,
Yeah,
if
not by
to-
like $10,000 either.
it's a significant change. So which is why a lot of cities artificially inflated that, because they didn't want to pay, because that's money that has to go into the pension funds every year. So I think the strategy that I tend to favor is slowly lowering it over time, which makes your pension doesn't look better on paper, but in reality it's better funded because you're projecting a lower rate of return. So my recommendation is to lower by 5 basis points a year for the next 5 years, which would bring us down from 7.25% to 7%, which I think is realistic to do without necessarily creating a budget crisis.
Because according to what GASB 75, we now have to report unfunded pension liability and OPEB as part of the financial and audit reports.
Yeah, which we didn't have to do until that change.
Which
And
the
that
bigger
really-
the bigger the liability, it hurts our ability to borrow should we ever have to do that in the future, charges more interest, et cetera.
But to be fair, I mean, you had all that unfunded liability that wasn't showing up anywhere.
Sure, it wasn't
wasn't
transparent to the taxpayer.
Yeah, and so they didn't see particularly things like those long-term healthcare costs that you had on employees. Another question, because again, I'm not a licensed financial planner. I've got a driver's license and a fishing license. So, the role of the actuary. How does the actuary dovetail into all of this process, and who picks the actuary?
We do.
Okay.
I mean, they're just a private
I know
consultancy.
I'm asking some basic questions.
No, I mean, that's,
apologize for
and I
just
think
trying to-
it's the actuarial science is kind of a mystery, although it's a very lucrative field if you have a talent for math, because
yeah.
actuaries are very well compensated, and they do not only pensions, but all kinds of different risk analyses, and like whether it's life insurance, term insurance, all these things. So it's, I'm guessing we've had the same actuaries in place for years, if not decades. And it is like any professional service, something that should be, normally you go through an RFQ, or request for qualifications, and select firms based on, as opposed to like a proposal or price. And I think in talking to Pat, to Michael Schoen, and other people from Marquette, there's like 4 big firms that do most of the pension work in Pennsylvania that,
Mr. Decker's spot on with that, and I certainly think, and I don't know this for certain, but I don't know how long these contracts have been in place, but really with anything in the investment management industry, there's been a lot of fee compression over time. So just another reason that these contracts have been in place for a long time to maybe take a look at. And then there's usually scale, to the extent you wouldn't want to use one provider as opposed to 3, to the extent that that's palatable. And admittedly, I don't know that. You can experience some scale as it relates to fees as well. So that's another consideration.
one thing that we don't currently provide employees is an annual benefit statement, to like an estimate if you continue to working and retire at this point based on this salary, this is what your expected benefits should be. That's something that I think every employee who's vested in the pension should get every year, to say, well, if I'm going to be doing financial planning for my future, if I keep working and this is what I think I can get from the pension with all the disclaimers, but part of this is making sure the information gets to you, which I'm going to guess this is the first time you've heard an investment presentation on pension funds. And the other layer is making sure the information gets out to the employees and retirees, because I think what Pat will affirm is having a written investment policy statement is just, it's somewhere between a best practice and an absolute requirement for a fiduciary responsibility, is to say what your investment strategy is. And this is a living document. This isn't something that you adopt and then just don't revisit. Probably every year, we'll go back, evaluate the performance of the pension funds, bring it to you, bring it to the pension boards, and then say, do we need to adjust how we're investing the pension fund's money based on what hopefully the investment advisors see as the long-term economic outlook by sector.
That's spot on. And, related to that, not just the current market environment and our projections of what we think is going to happen, but each of the funds have their own unique characteristics and constraints. So to the extent that anything changes from a participant perspective, from a city perspective, then that information is also crucial to know and to revisit on an annual basis, and could be quite relevant, just like the market outlook, to incorporate into the investment policy statement as well. So there's a bunch of different pieces. It's not just asset allocation, but other things to consider, and that's reason number one, really, as Mr. Decker alluded to revisit this, annually, but really no less than every couple years at a minimum.
Anybody have anything else? Okay. Thank you, Pat.
Thank you all. Appreciate it.
Okay, we'll move on to public comment. If anybody would like to address council, you may do so by calling the number on the screen. Please give your name and address when you are asked to do so. And we ask that you keep your comments to under 5 minutes. And the floor is now open. Seeing none, we will close the floor for public comment, and we will move on to the resolutions. Linda?
Item A is approving the minutes of the Altoona City Council meeting held Monday, February the 8th, 2021. Item B is approving an election polling place agreement between the county on behalf of the Board of Elections and the City of Altoona for polling place location at the City of Altoona Training Facility and Council Chambers and Fire Stations 1, 2, and 3 for the 2021 primary and general elections, and further authorizing the city manager to execute all documents and the city clerk to attest to same. Item C is appointing Timothy Height to the Amtran Authority to fill the unexpired term of Michael Robinson. Said term shall expire the first Monday of January 2024. Item D is awarding the 2021 Cdbg Street Reconstruction Project to Granis Brothers of Hollidaysburg in the amount of $196,913.26 payable from the Cdbg funds, and further authorizing the city manager to execute all documents and the city clerk to attest to same. Item E is approving a 10-year lease agreement with Lois Hampton of 5704 Maryland Avenue for property located at 5708 to 10 Maryland Avenue in the amount of $1 per year, and further authorizing the city manager to execute all documents and the city clerk to attest to same. Item F is approving the execution of the declaration of restrictive covenants for conservation in Annis Township, Blair County, as referenced in the attached agreement for the Altoona Water Authority Bellwood Dam modifications, and further authorizing the mayor to execute all documents and the city clerk to attest to same. Item G is approving the appointment of city manager Ken Decker as chief administrative officer of the city's 3 pension plans. Item H is approving a repository bid in the amount of $200 submitted by Anna Arthur of 1006 East Atlantic Avenue, Apartment 4, and Andrew Doran of 226 East Crawford Avenue for property located at 224 Crawford Avenue, and further authorizing the city manager to execute the taxing district form. Item I is approving a repository bid in the amount of $250 submitted by Antoine Lohner of 513 South Juniata Street, Hollidaysburg, for property located at 304 2nd Avenue, and further authorizing the city manager to execute the taxing district form. Item J is approving a repository bid in the amount of $250 submitted by Antoine Lohner for property located at 306 2nd Avenue, and further authorizing the city manager to execute the taxing district form. Item K is approving a repository bid in the amount of $250 submitted by Donald Bowser of 1307 19th Avenue for property located at 725 North 5th Avenue, and further authorizing the city manager to execute all the taxing district form. Are there any additions or deletions or anything that needs to be pulled for a separate vote?
I just had a quick question for item G. Is this like a temporary appointment, Ken, for you until we get like the finance director position filled, or?
Well, it could be, but.
I guess I'm just asking your plans, or, you know.
Well, I mean, I sit on 2 of the 3 pension boards and attend the police pension board, but just for the sake of signing some of the documents that need to be signed, it's just an administrative convenience. So if we come to a point where we hire the finance director, that person settles in, I have no problem letting somebody else do that. But just given the amount of involvement I've had with the pensions to date, it seems to make sense to have me at least, sign on the relevant documents, which is pretty much all that's there for.
Cool. Thanks.
I was going to ask the same question. I also had a question on E, and Linda, maybe you can answer. Is this the same lease that we've had with this person, that we're just renewing it for another?
Yes.
Okay. All right, that's all.
For a side yard. She has a garden, I believe,
Right.
on it. Mhm.
Right, we've done this before, and we're just renewing it for another 10. Okay. Thank you.
We have other leases out there too, don't we?
Yes. This
Okay.
one is for that area where you're not allowed to, in this floodplain,
Yeah,
you're not allowed to
we-
build. and
across the
properties.
stream from the Logan Valley
Mhm.
Mall. Yep.
Before I go too Linda, can I just clarify on B, what do we, as part of the election, I just want to make sure that I'm understanding that. What are we voting for on the election board agreement? Is that they are going to continue here for the primaries, or they're not going to continue?
That they're gonna continue.
They are going to continue.
They've never had agreements in place in writing. This is something new that we were sent this year, and they asked us to have them signed and returned.
Okay.
Nothing really changes, other than it just says that they have rights to come to the building the day before, the day of. And I think I don't see where they used to pay a small fee. I don't think that they pay the fee anymore, and they haven't mentioned anything about cleaning, which they only did that the one time for coronavirus earlier, like a year ago, probably.
Right, okay.
But that's not in this document.
Councilman, I did look at the agreement and a few weeks ago. I didn't see any problems with it. So.
And we are required by state law to make municipal facilities available for polling locations.
I know a few years ago when we had problems finding polling locations, and I think it was Mayor Scherf and I went around the city looking, and one of the toughest things is finding polling locations that are ADA compliant. It's very difficult to find those. And I was wondering why. I know we have a polling place here, but we also have one over at station number 1, and it'd be nice at some point if those can be combined to just perhaps have them here. Or,
The one that's here is from the Keith area.
yeah.
It was moved out of the Keith Junior High School. When it was re-renovated, they did not, right now, the community room is not handicap accessible. They've
Mhm.
never done that, so
Makes
they,
sense.
That's 3-2.
we came here, they came here
Yeah.
temporarily and have been here ever since, so.
Probably for the reason we just spoke
Yeah.
about, because it's very difficult finding ADA
Were
compliant.
were they still using the public library, and will the public library be available for the primary?
Not sure.
We can ask the library. I mean, the library's working out of the transportation center now, but it really falls to the county's Board of Elections to,
Right.
but if it means, we certainly could make the space at the transportation center available if that's a location that the Board of Elections would like to use in lieu of the library.
I'm good, I'm ready to vote.
Okay, now call for the consent vote. Vice Mayor Butterbaugh,
Yes.
Councilman Kashadi,
Yes.
Councilman Carper,
Yes.
Councilman Ickes,
Yes.
Councilwoman Jordan is absent, Councilman Kelly,
Yes.
Mayor Pacifico.
Yes.
And the consent vote passes 6-0. And we have 2 ordinances on the agenda for adoption. The first ordinance was introduced by Mayor Pacifico, and it's an ordinance amending the code of the city of Altoona by creating Chapter 262 condemnation orders to implement Act of October of 2020, Public Law 101, entitled Municipality Condemnation Order Act, as adopted by the Commonwealth of Pennsylvania, to provide for its administration, severability of provisions, and providing an effective date. Is there a motion for adoption?
So moved.
Second.
Dave, was that you? Councilman?
Who
Who was the second? I'm sorry.
Jesse.
Oh, okay. I totally missed that. Okay, this ordinance was moved for adoption by Mayor Pacifico and seconded by Councilman Ickes, and I will take the roll for a vote. Vice Mayor Butterbaugh,
Yes.
Councilman Kashadi,
Yes.
Councilman Carper,
Yes.
Councilman Ickes,
Yes.
Councilwoman Jordan is absent, Councilman Kelly,
Yes.
and Mayor Pacifico.
Yes.
The vote passes 6-0. And we have a second ordinance for adoption, which was introduced by Vice Mayor Butterbaugh. It's an ordinance amending the code of the city of Altoona, Chapter 536, entitled Registration of Vacant Buildings, by replacing it in its entirety, create 3 categories of vacant buildings, including 1, neglected buildings, 2, derelict buildings, and 3, unsafe buildings, requiring registration and inspection of vacant buildings, to provide for administration, enforcement, and appeals, repeal of all other ordinances or parts of laws in conflict therewith, severability of provisions, and providing an effective date. Is there a motion for adoption?
So moved.
This ordinance was moved for adoption by Vice Mayor Butterbaugh, seconded by Councilman Kashadi, and I will call the roll for a vote. Vice Mayor Butterbaugh,
Yes.
Councilman Kashadi,
Yes.
Councilman Carper,
Yes.
Councilman Ickes,
Yes.
Councilwoman Jordan is absent, Councilman Kelly,
Yes.
and Mayor Pacifico.
Yes.
And the vote passes 6-0.
Okay, we'll move on to city manager updates. Ken?
So on the pension IPS, we'll draft a resolution for your consideration for your next meeting. If there are any further questions you have at the, we can cover those at the work session. By way of update, the money in the fire pension fund has started to transition from Wells Fargo to US Bank. We're optimistic that that's going to continue with the non-uniform pension fund. However, we've continued to have some difficulties dealing with Principal, which is the sort of parent organization. The police pension board took action to move the pension fund into a different structure. And Omar's been working very diligently, but the goalposts keep moving on us. I don't know, Pat, if you have anything you want to add on that, but
I think you covered quite well. The goalposts have moved regularly, and now we're at a point where we're not getting a lot of responses from them at this point. U.S. Bank, the new bank, has been working quite diligently in trying to move this forward, and to some extent we're not getting responses, so we're kind of running in place right now for the police transition. Like Mr. Decker mentioned, we're fully confident that the other two are going to move forward, hopefully be complete by the end of next week. But for right now, I've heard from U.S. Bank that they are getting no responses at this point from Wells Fargo. So that remains up in the air as things stand today about how to move forward, quite frankly.
well, we do have the nuclear Tom Finn option. So, I mean, that's my thought is that we're going to involve the solicitor to see if we can't start walking our way up the corporate chain to get somebody, because it's the city's money, it's retirees' money, and it just shouldn't be this hard. And I think what Pat has said, that this is unlike anything he's ever seen previously in terms of difficulty with a custodial firm transferring assets. So,
I mean, this is a regular occurrence, right? I mean, well, I'm sure Wells Fargo has done this many, many a times in the past where assets have been transferred away from the bank and even transferred into the bank. So it's unclear to me exactly what other dynamics may be at play here for them, quite frankly, being a little obstinate about the whole process. So to Mr. Decker's point, yes, this is unlike anything we've run into in the past, and we've facilitated hundreds of these sorts of transitions over the years.
So we'll work on that. Tax bills have been mailed, which is always kind of like the opposite of Christmas. So our phones have been lighting up at City Hall because we've had, and we've had a substantial foot turnout of people coming in, because we have, I think, people who just go to the mailbox, immediately get in their car and go to City Hall to pay their taxes. So appreciate the diligence. We did a site inspection of Mccrory's building. Appreciate Tom Finn taking his life into his own hands and walking throughout the building. We provided photos to the council, but I don't think anything is a substitute for seeing it in person. I've had communication with an engineering firm, and we're getting some prices on a structural inspection and phase 1 and phase 2 environmental inspections. But and I think Attorney Finn has sent some correspondence to the attorney representing the property owner to try to part the waters, no pun intended, and move forward on this. But it was in worse shape than I anticipated.
I appreciate the fact that you did that, and appreciate the photos. It's been 5 years or more since I've been in that building, and it was pretty rough then. Any first blush comments you have once since you were able to get inside, and were you able to get on any of the upper floors?
Yes,
okay.
But not out on the floor deck. We stayed in the stairwell for safety reasons.
Yeah, I know Chief Heilman and a couple of the inspectors from the fire department were with us, and they went up and looked at each floor, and specifically the recollection I had was that the floor, I think the term was spongy, and they weren't really inclined to
Well, that's not a good term.
they weren't really inclined
Wow.
to test it too much. They did take extensive photographs, and they even went up. They took the steps up to the roof, took photographs of the roof. There's obviously concerns, but we're trying to take steps to kind of move this forward. So
Yeah, we do have water intrusion on the. In addition to the I'm guessing 3 feet of water in the basement, and there really is a boat.
Yeah.
But what we saw was a collection of puddling water on the first and second floors, indicative of roof leakage, and there's a large HVAC unit on the roof that has taken a bit of a lean. It's on, looks like some kind of composite or concrete pillars. So it's Chief Heilman, did you want to pop in on this?
Well, and I think that's critical too, because that was the demise of the Woolworth building, was the fact that the roof failed
Yeah.
and caved in, and the building then had to be demolished. So, hi,
Yeah,
Tim.
the things, this building, so the second and third floor was my concern, because I hadn't been in there, wasn't able to get up there the last time because they had equipment blocking the stairwell, which was a concern, obviously, for firefighting and the safety of our firefighters. But the floors now are so bad that we wouldn't even walk out very far from it. I took 3 or 4 steps from the stairwell, so the floor was, it actually dropped far enough that I jumped back because I was afraid of falling through. Throughout the place, they cut holes in the floors to get equipment and materials that were in there down without having to carry them down the steps. And they didn't cover any of the holes back up and seal any of it back up. So if that place ever caught on fire,
Spread quick.
it's an absolute death trap. And the water in the basement hasn't gone any better in the last year.
What's the depth of the water in the basement, do you think?
3 to 4 feet.
Yeah.
Yeah, it was, when I was in 5 or so years ago with the developers, potential developers from Harrisburg, it was only a couple inches. I would say it was, but you would be in the basement, and it was a nice sunny day, a summer day. You could hear water running. It sounded like an artesian well.
The roof is another issue that we identified on this trip down. There's air handling units that weigh excess of 10 to 15,000 pounds. And the roof is so bad we couldn't even go out on it. The membrane itself was pulled away from the front of the building, and there's probably 3 or 4 feet of space between the membrane and the roof. That's how bad the roof is.
Well, that's not good.
So
Well, that was my
Wow.
question and concern. Can
Wow.
we have them, can we make them supply a structural engineering report? Because the fake one that they handed in a while back does not satisfy me. And I got concerns about just even the public on the outside of the building.
Building on that, has there been any communication since the last, like the last time we met with the owner? Have they reached?
He was with us when we entered the building.
Yeah.
Yes. Well,
Mr.
one of the owners.
Well, that, like the representative that lives locally. So from what I'm hearing, it sounds to me like this would be category 3 or somewhere between 2 and 3 according to our new ordinance.
I think it's clearly an unsafe structure.
That's what I would think.
But in terms of requiring, I mean, at this point, proceeding, I think having an independent evaluation is better than, and honestly, I spoke to the owner's representative, and what he told me was some kind of vague plan about continuing to clean things up over the next few months to possibly market it over the summer, but there's no evidence that really anything's been hauled away. There's debris, there's junk, there's just odd materials throughout the building. There are a couple dumpsters next to the building, but I mean, it would.
What's the story on the dumpsters?
The plan is there's probably 100 black trash bags full of trash stacked up in one side of the first floor, and to move those trash bags from the building to the dumpsters.
So, I believe at the work session, when we talked, there was kind of a hope that the building might be salvageable, but based on your analysis, I mean, you were in there. Do you think that that's still the hope, or do you think that that's?
I don't see. I mean, I'm not a developer. I'm
Right.
not a contractor. But from the standpoint of from public safety, to get that down to the bones to where you'd have to start over, it wouldn't even be a safe structure to stand there while they're even doing that. In my opinion, it would be dangerous.
Right, and you enter
yeah.
dangerous facilities all the time. So
This one is probably one of the more dangerous in downtown, if not the most.
The bones of the building in terms of the walls, I mean, amazingly enough, because we went to the clay cut basement, which I thought would have suffered from some water intrusion, given the fact that there's a pool, in the adjoining wall, but it's a very heavy stone foundation. There doesn't seem to be. Now, there's historically water damage because they removed the lath and plaster along the bottom of the basement, but the big difference is I guess with enough money, the building could be salvaged, but the more it falls into rack and ruin, the more expensive it's going to be and because it's not ADA compliant, there's no interior
Right.
elevator system, or, I mean, if the building were to be renovated to some kind of useful purpose, you'd have the cost of putting an elevator in.
From last year to this year, I think if you'd asked that same question last year when we were in March, I think the answer would have been there's a chance, there's a possibility for it. But since there's so much water intrusion now that has gone from the roof all the way to the basement, we didn't see any damage in the first floor from like roof leakage. It was basically all just cosmetic stuff. But this now, there's pooling water on the first floor, and the entire skim coat of plaster on the roof and the first floor has come down on top of everything in the first floor. So I mean, at this point now, because of the water intrusion, the answer is completely different
Right.
today than it was last year.
So I guess, and I realize you're not a
Yeah.
structural engineer or anything like that, but given your experience, do you think that there's an imminent structure failure?
The only part in it that I would say is imminent, that you could actually even come close to saying imminent, is internal, where the air conditioning and the air handling units are on the roof, and the roof being in such bad condition. That could fall if the roof fails, because there's so much weight there. And I don't know. I mean, that would definitely cause hazard for somebody inside the building, obviously, and that's why we made it so that it's uninhabitable. But as far as the building just standing there now, I don't know that it's posing an immediate threat to where we need to take bulldozers in right now to tear it down. But the longer it sits with that much water damage and with that air handling unit on the roof, if it goes down through, it's going to pull the building down with it.
Refresh my memory. Have we sent them a notice to raise that, or
It's been red tagged.
It's
I mean,
condemned.
The
so
building's
got
Rebecca's handled
condemnation.
so I mean, and the doors are locked by the fire department, but we have allowed the property owner access. We had thought that he was retrieving his personal belongings from the interior of the building. So we've certainly accommodated all of his requests for access.
Ken, I don't want to go too far afield with this because there's just a
A
lot
lot
of
there.
variables here, but you came here from the Maryland area, and I know you'd see this in Baltimore and like Fells Point, where they would save the facade.
Sure.
And that way the developer could still get some historic, I think the developer was still able to get some historic tax credits for the project by saving the facade. But basically everything behind the facade
Sure.
was new. And they did that in Lancaster. Some of us were down in Lancaster for the League's convention at the Marriott that they built, which they saved the facade of the old Wattenshand department store.
Mm-hmm.
So, okay. Well,
So
that was
certainly that would be a creative way to keep the historic
look
storefront
to it, yeah.
to it, but I'm not sure. But we'll know a lot more after the structural, because given the age of the building, the condition of the timbers, I mean, but they've done stuff like cutting holes in the floor, which have not been conducive to the structural integrity of the building.
How soon would we expect to hear from to get a report from a structural engineer?
I don't think once we get somebody on site under contract, I think 4 to 6 weeks max. The environmental assessment will take longer because there's testing that has to be done. We've had the media coverage has generated some interest from private developers who are interested. I think, if facilitating a private transaction to a firm or individual with the resources and interest to do something with the building is in the city's best interest. So we can certainly, working with Tom, try to facilitate that access, because somebody who does this for a living, I mean, a contractor who renovates historic structures may have a different impression than we do.
Is there any idea where the water could be coming from? I mean, 3 to 4 feet is.
I think it's a sump from the entire downtown. I mean, that block, I think it's the
okay.
low point where the water gathers.
Yeah,
that's true.
and you don't know how long it's been there and not pumped out, so it could be every time there's a good rain, more water's just being added to it.
We've had a damp winter.
But I mean, it's like I said, when I was in there 5-6 years ago, there was probably 6 inches of water on the floor. Now there's 3 feet. I mean, I don't think they're even, doing anything to pump the water out, so.
I mean, I would tour the building, but I don't want to die in the Mccrory's building.
I think honestly, I think you're better off just looking at the pictures that were provided to us. I wouldn't, I mean, it was pretty rough when I was in there before, and we were only on the first floor and went down the steps to the basement. But, what a shame.
The
I'm
biggest
just,
concern we had was like maybe squatters or something going in there to stay in there.
That was another
or
thing I
mess
had
around
sure
in there,
too.
do whatever. So that's why we made a decision to padlock the building and make it so that it's secure, so you can't go in there and hang out. Because I think one of the employees of the representative that was with us had left him some messages
Oh,
there.
yeah.
And
Yeah.
had left some
Yeah.
things that he had been in there. So obviously the building wasn't secure before we padlocked it up. So at this point, I think that's about as safe as we can make the building right now as far as that goes. My concern too is with the clay cup being right there. It's a great business in downtown, and having that danger right there is something that's a serious concern.
We get a little more out of COVID, and you have Penn State students downtown, and you have people going to the cardiology office there, or people driving down the avenue to drop things off at the post office. I mean, if that thing would go down, it's not going to be.
I'm not an engineer, but I wouldn't say it's in any danger of collapsing like that. There's nothing coming off the facade. There's more of that down at the other end of the block with the other property down there on the outsides. But the outside of this building is in fairly decent shape. It's just all inside because it's all wood truss and wood. The whole infrastructure is wood.
No steel in it. Wow, that makes a big difference.
I mean, the joists on the third floor where they had cut it open, I mean, the boards were over 12 inches, the joists. They're huge. But they're soaked. They're soaked all the way through. So
So you're not worried about it catching fire then, obviously.
well, I mean, there's
I
still
mean, and I'm sorry, I don't mean to.
there's
make
still
light.
a lot
This is
of
horrible
there's still a lot of
situation.
combustibles in there. We did make them get all the flammables out because they had kerosene, gasoline, and diesel in there. They were just storing in there. So that was another reason why we wanted to get
Well, what's in the
Place pack up.
150 black trash bags?
I didn't
Yes.
look.
plaster.
Yeah, probably just,
So it's debris that they
Yeah.
Plaster's
picked up
falling
and
off
put in
the walls, they
contractor
picked up,
bags,
yeah.
and they just haven't made it out to the dumpster yet. Wow.
Those dumpsters were put there after. I think they
after the publicity.
after the thing stopped with where on I think it was February 18th when we were told by codes and everybody else that we weren't to allow them back in. So from the 18th till now is when the dumpster showed up. But there has been not a time that the fire department hasn't let them in when they asked. In fact, we were going down there pretty much every day for weeks at 8 o'clock in the morning and letting them in. And then making sure we're secure, because we need to know when someone's in there, if something would happen. I'm not sending anybody in there unless, there's some kind of life safety issue. So we wanted to make sure there was no life safety issue for us. That's why we were letting them in.
Well, there's no power to the building. I presume the water's turned off.
Yeah.
And then.
Well, they do have a service, because I asked the property owner's representative, and they pulled the old Penelec, but there's a panel, it's just not energized to the best of my knowledge. So, but there is a new, looks like a 400 amp service, I'm guessing.
Wow.
So to segue, Mccrory's, the transportation center is in better shape than Mccrory's, although we have had a spate of plumbing related issues there. So we've, Chief Heilman's been great about helping with that, so is Nate, but we're, there are just some issues with the age of the property, and we have very poor fall from where the current facilities are to the sewer main. So we've had some clogging that, including some grease that may have been related to previous occupancy. So we're just trying to kind of get through, but the library and CareerNet are settled in, and they're both appreciative of the space, and we're just trying to, responding to problems as they come up.
Yeah, I did look quickly online, and 6th Ward 1st Precinct is listed as voting at the public library, so we may want to reach out, Ken,
Yeah.
as a courtesy. I mean, I'm sure the county will be talking to the library about that, but I don't know if they'll be able to be open by then, that could be a polling place, and I don't know that we'd have anything else that we could offer for them to come and vote, so.
It's actually pretty central. It's ADA accessible. There's
Yeah.
ample parking around there, so I mean I think it would be, and both the library and CareerNet have been good to work with. The career link, I guess people put up a dish. I won't tell you how much Atlantic Broadband said it would cost for them to connect high-speed broadband to the premises, but it was a lot of money. So they got some kind of dish that they're bouncing off the top of the parking garage to get broadband to that area. But if we get into renovation, what we'll do is we'll probably try to get some dedicated fiber to the premises so we can provide the needs of whoever's going to be there. But it's good to have the space being used. One of the things I'm considering for April is a spring cleaning day for City Hall where we close the doors, we'll answer the phones, but we have just a lot of papers accumulated that we just need a good thorough spring cleaning. So I've done this in the past. We'll have people show up in casual clothes, but with some of the transitions in community development, we're finding boxes of papers that, of mysterious origin. I think City Hall just would benefit by a good, what we would say in the military, a field day. So Tom's, by the way, I'll give my usual plug, has been super helpful when we've run into things like deeds and other things that we've been trying to find. But we just need to have a better sort of document management system, and the first step of that is cleaning.
To that end, do we have a retention policy on documents?
As Linda and Kim said, I think we have one. I'm just not sure how closely it's been followed by all the departments.
Okay.
Did we have somebody scanning documents and filing like PDF type of files?
We did. I think I've been told there was an intern or a temporary worker who spent the summer just scanning stuff in, but one of the things that we're going to be doing a better job is making sure developers give us everything digitally. So it's a lot easier to find something on a hard drive than it is in a basement. So we're gonna continue focusing on that. But I think we also are overdue for a shredding, which I know is an expense, but that's part of document retention and management is destroying documents. But some of the documents we have sensitive information. So I think there are firms that will just show up with a big truck and shred everything. And part of the problem is I think we have more room than we need in City Hall, so empty rooms tend to accumulate stuff. So there was some discussion on council about closing a 14th again this year, and I think some days were kicked around in terms of that's the short section of street next to a couple of the downtown restaurants. We had put tents up there last year, so is that something you want to talk about in the work session in terms of the timing of doing that? Because just looking for some direction.
Yeah, I had expressed some concerns, not as a response into the email, but when we looked to do that last year, there were a couple of things that were factored in. One was the fact that we were deep in the midst of COVID with a lot of restrictions on eateries. We had said at the time the discussion was, well, it would be nice to provide some ancillary area that they could have seating outside to help these establishments out since they're in the core downtown. But Heritage Plaza wasn't available because of construction. So Heritage Plaza is done, and I just think it merits some further discussion. I just always worry, when we start closing a street for any particular reason. So.
Okay. I mean, if the work session, I think the economic development people had some interest in that discussion. So if you want to put it on the work session for the month, we can have Pat Miller or whomever might be interested to come in to talk about it. But it's, we're at the council's disposal, open, close, whatever you guys want to do.
Well, and is the farmer's market coming back?
Yes, I think that's what we understand is that there will be a farmer's market at Heritage Plaza this year.
Okay.
So, the public restrooms are currently winterized. We wouldn't normally take them out of that until first week or two of April, when we're safely out of the frost season, not to blow up our new pipes down there. So, but we are excited to have the plaza, and Tom's been helpful with some of the public gathering stuff, because we're expecting it to be used more frequently in the coming year as we come out of COVID, and because I mean with the pavilion there, it's just a nicer facility. But we'll put that on the work session. Another thing to talk about the work session is an embankment location. Public Works is running out of space where we put spoils, where we dig holes and we need to put the dirt someplace. We have a couple of locations that might work, but both are in Logan Township. So I can, I'll have Nate provide some further information, but I just have this sense that there might be some challenges involved in securing those sites for that use. We own the property, but it certainly has to go through a process.
Okay.
The deadline for CDBG projects is coming up. I know that Mayor Pacifico last year had asked to make sure the council got information on the projects before the projects just sort of popped up at the council level for approval. So when we gather the information, we'll try to provide that. I don't know where we are in terms of, I understand that the allocation is about 1.6 million. I don't know what we have in terms of asks at the moment, but as soon as we have that information, we'll try to push it out. I've also understand that one of our demo program employees is choosing to retire, and I had it on my list of things to do to talk about the demo program, which is currently now a 2-person city program. So I'd like to continue that conversation, because we've talked about a couple of options. One maybe being segueing away from demoing houses using CDBG funds and using that same source of revenue to build some sidewalks in the city. So that's something I'd be interested in pursuing further. And if there's going to be some personnel changes, it might be an ideal time to try to take a look at that. Prospect Park Pool, I appreciate the responsiveness of the council. It's another difficult subject, but I think that based on my conversation with Mike Hofer of CBRC today, that having a joint meeting in May might be a useful dialogue, because there's nothing there that's going to be easy or inexpensive, because it's a really big pool. It's an old pool, and it apparently has some significant issues. So I wasn't here for the Juniata, the conversion of that pool into the splash park, but I understand that was, kind of a long process. So before we get to like a crisis point where money is being required to be spent on it, I thought it'd be good to have some dialogue on the front end on that. Finally, I've got a meeting with county staff. We have another transition in community development. The individual who is doing our GIS work is retiring. But we've had sort of this long-standing challenge of data coming to us from the tax office in the county that I think we want to work collaboratively with them to try to make the process more efficient and less labor-intensive. So we're continuing to clean things up on the land use front, and it's certainly the pace on the planning projects and planning review, land development review. It's a busy time for us, because there's just a lot going on. So if there's any questions I can answer for the council?
I know, the Senate approved a $1.9 trillion stimulus plan. Do we have any idea what's in that for potential municipalities that will allegedly be our saving grace?
Well, it was 65 billion, but for local governments, I don't know what Haven't seen any breakdowns of what any preliminary figures might look like yet.
I think Senator Johnson forced it to be read on the floor of the Senate, so somebody could probably send you that 7-hour clip if you want it.
It only took him 7 hours. I'm actually surprised it was that short. Thank you.
Ken, I guess with regard to COVID then, have we had any concerns yet about revenues dipping?
No, I mean, I know we have some reports that you're going to be anxious to see because this is about the time of the year we put together the total compensation report for you. I know that, but it's still early in terms of, tax revenues. But my sense is, and this is more of an intuitive thing, that the economy is doing better than we would expect. And based on everything I've read, we expect the second half of this year to have some explosive economic activity because of the pent-up demand for travel, for recreation, for leisure. So, and as Councilman Ickes notes, on the fire that is the U.S. economy, there's 1.9 trillion gallons of gasoline that's going to be poured on it. So, I think it's going to be tough because we don't know what the economy is going to look like, and $1,400 more to everyone is going to make a big impact.
That was my concern when you were given the report, because where does the devaluation of the dollar come in with all this, or inflation?
So a couple of different places. So number one, think about the marginal changes versus that current. You'll notice an increase in the ratio between U.S. and non-U.S. stocks.
Yes.
So by default, when you invest in non-U.S. equities, you also have the currency component of that. And if inflation is hotter than expected, we should, in theory, expect a depreciating dollar, which in turn would boost the international equity returns. And then related to that, when we think about core real estate and infrastructure, those two assets, which the various funds don't hold right now, are typically called, say, real assets or, inflation sensitive assets. So to the extent that investors look for, quote unquote, insurance around those possibilities, those are two asset classes which aren't in there right now, which, if they're added, should help alleviate any of that uptick in inflation. And then one more, bringing down the fixed income allocation, higher inflation, higher rates. We've seen that in anticipation of this kindling.
Yeah.
And who knows, we may see an infrastructure bill in short order if things come to pass over the next few months, which would just add further to it. So less in fixed income, less inflation, less interest rate risk. So on the margin, if we do see this large pickup in activity, pickup in inflation, moving from that current to this other mix should be more protective from that sort of scenario, given those changes.
Thank you.
You're welcome.
I don't know how many members of the council are old enough to remember stagflation and Ronald Reagan and Paul Volcker breaking the back of inflation in the early 80s.
It was ugly. I wasn't here, but it was ugly.
Yeah, I mean, an inflationary environment for local government is brutal because it takes a while for tax base to kick in. So the price of us, and we're seeing it in fuel prices a little bit right now.
Right.
The prices for us go up really quickly. The revenues go up really slowly. So
I'm old enough to remember when certificates of deposit were paying over 15%.
wow,
Yeah, back in the.
that would have been 81.
Yep.
And Altoona's in this area where we hit the recession earlier and we stay in it longer.
Yeah. That was back in a day when people were taking student loan money, even if they didn't need it, they were investing it.
Yeah.
And making a
Arbitrage.
higher rate of return than what they were. So.
Yeah.
Okay. Anybody have anything else for Ken?
No, thank you for the whole Mccrory's thing. I really think we need to be vigilant.
We're going to stay on it.
Yeah, I mean, it's because it's just a bad situation,
Yeah.
and I think the sooner we know how bad, and then I think we can make a decision on which way we want to go. So I thank you for all the efforts on that. So
Well, I appreciate the counsel. When you tell us something's important, it's important, and we treat it like that. So, we're gonna be like a dog with a bone on this thing. So one way or another, we'll resolve it, or at least bring it to the point where the council knows what it wants to do, because I think a decision has to be made on this. It's unwise for us to allow the building to make the decision for us.
All right, moving on to council items. Councilman Carper.
Nothing at this time, Mayor, thank you.
Councilman Kelly.
No, we've covered a wide swath of things, and I'm good. Thanks, Mayor.
Councilman Butterball.
One of the things I was thinking about there when we were discussing the Mccrory building, that is, the water situation is not just one or two buildings downtown, but that's been an issue for a long time, for decades. And we may want to long-term start thinking about or planning if there's anything we can do to alleviate in any way, or some kind of infrastructure that would help out some of our buildings, because I know even the buildings that are being well maintained and that are being well taken care of still have the water problems in those too. Thanks.
Thank you. Councilman Kashadi.
No, sir. Thank you.
Councilman Ickes.
Thank you, Pat, for joining us this evening. And I think Councilman Kelly said earlier that this is probably the most in-depth view we've had here on the public pension plan. So really appreciate the admin's work here on this through this process, and hopefully we have the full conversion in place sooner rather than later.
Thank you. Take questions from the media now. Bill.
Thank you. Why, this may be a dumb question, but why have a presentation on the police pension, but not the other two? Like, why not all three at once, or?
There's a different structure which really starts in the third class city code, which, because it's Pennsylvania, we're still tied to as a home rule city because it involves pensions. The membership of the non-uniform and the fire pension is a majority city employees or city officials. By statute, the police pension is comprised of police officers or retired police officers. So since the pension board is made up of people who aren't the mayor and council, the law says that the mayor and council are the final authority for all of those pension funds. It hasn't been applied that way in the past.
I'm sorry, I did.
It's a different law. I mean, there's 3 different laws. So the council gets to basically control who the staff are, and they're the majority on both the fire and non-uniform boards. Since the police elect their own pension board members, the way the law is written, the mayor and council have the final say over the investments in the police pension fund. So that's why Pat gave the same presentation to the other 2 boards, but because of a weird thing of Pennsylvania law, the mayor and council have the final authority on the police pension investments.
And in a sense, they have the final authority on the other 2 by
yeah.
virtue of being part of the boards. Is that
It's their world, we just live here.
But I mean,
Yeah.
that's what you're saying is
Yeah.
they're part of the other boards.
But they just do it by controlling the staff on the board or the people who are, because the ordinances are adopted by the mayor and council. It's just, like I said, it's just a weird little thing.
Okay, well, then what's the decision today? It wasn't made today, was it?
No.
So, council at some point in the future is gonna decide which strategy to
Yes.
take?
Bill, the police and the fire and non-uniform, they already decided for their.
On option B, or option D, wasn't it?
Yes.
Pat, can you explain real briefly what option D is?
So option D would be incorporating equities, like has historically been used, fixed income as well, which has been historically used, changing those allocations slightly, but then incorporating infrastructure and real estate to a small degree to complement those other asset classes.
Okay. Thank you.
You're welcome.
Phil,
you want me to leave that there so you can copy that, or?
Yeah,
I'll
or
let you
if
look
I
at
could
it.
get a copy at some point from somebody.
You can have mine, I've got like 3 of them.
Yeah, thank you. Thanks.
Yep.
Oh, well, this is sort of a philosophical kind of question. Is the success of a pension plan, any one of the 3, is it incumbent on council to make sure that they do the best they can, because the taxpayers are ultimately on the hook for the benefits? If that makes sense?
That's a slow pitch down the middle of the plate for
Well-
Councilman Ickes.
Well, something that I've been thinking of the whole time that we need to remind everybody of, the state makes us do it this way. It's not like we have a choice between defined contribution versus defined benefit. And the private sector has moved away from defined benefit, but the state,
The state has as well.
yeah, but the municipalities cannot do that by state law, by state mandate.
Mhm. So in a sense, the taxpayers are on the hook to make sure these benefits are,
100%.
Yeah.
Yes.
Yeah,
Whereas
I mean,
the-
absolutely, that's the
workers
bottom
don't.
line. Taxpayer, you know, this body, the city of Altoona, is responsible for the funding of those pensions, and that ultimately means it goes to the taxpayer if there's a shortfall.
Right, I
So-
mean, the employees are guaranteed to get this. to
Yes.
get these
Yes.
payments, right? Okay.
That's
Yeah.
hence defined
If the
benefit
pension,
as
if,
opposed to
if the
defined
pension plans
contribution.
were to become insolvent, then pension obligations become part of the general fund. So we would be making those payments regardless whether the plan existed or not.
Okay. And then, sort of in the same vein, Ken, are you planning, or is the city planning to do an RFP to get a single actuary to deal with all 3 plans?
Well, I think that's something, ultimately that decision rests with the 3 pension boards, but that's something that I'm gonna recommend as the manager, is that we shop it, because as Pat Wing pointed out, over the past 10 years, the fees have gone down for these kinds of services, and I think there's an efficiency in just having one firm we're dealing with all 3 plans, as opposed to having 3 separate entities. And I think, I can't stress this enough. This information is really important. So, and it's complicated. So a good actuary can explain this really complicated stuff in a way that the employees and the taxpayers can understand, which I think is our obligation, is to make sure that these numbers are transparent and clear to people.
Okay. And then, maybe this is for Pat. Could you explain, was, under Wells Fargo, did Wells Fargo take care of the banking aspect and also the investment control aspect? Whereas that's not gonna happen this time?
So let me speak to what will be moved going forward, and then I'll defer to somebody else on your first question. So moving forward, the banking aspects, or where the assets are actually held, will be U.S. Bank, will be the new custodian bank, and then we, Marquette Associates, an independent party from U.S. Bank, will be investing the assets on behalf of the various funds. Historically,
It was, Wells Fargo was both the custodian and the investment manager.
Is that, is there a conflict of interest involved in that, or is it just happen?
Well, I certainly wouldn't say conflict of interest. I think our preference is to have the banker that holds the money be someone different than the investment manager, because then the people holding the money are giving you reports, and then the investment managers are giving you reports, and then you have the advantage of comparing those two reports to make sure the numbers line up. There's also then no incentive because some of the firms that provide everything tend to want to invest money in their proprietary funds. Like if you're XYZ Bank and you have an investment division, then you end up getting put in XYZ mutual funds where they make money based on that. Marquette has no incentives whatsoever to put our money in any particular investment because they don't get paid that way.
That's the kind of thing I'm.
Yeah.
We have no proprietary funds, as Ken was alluding to. So Wells Fargo is a bank, an advisor, and then an asset manager. We're strictly an advisor. So those other services with the city and all of our clients, there's various parties. So not only are there actual conflicts of interest or the appearance of any conflicts.
And can you say why, if Wells Fargo had all three funds in its bank, why did they turn over the funds to the other two pension plans, but not to the police plan yet?
Okay, the police pension board made a decision, I think it was a year and a half ago, to move to a different structure, which is called, I think, principal IRT, which is part. So because of the decision they made, the money is actually in a different part of Wells Fargo than the other part where the other two funds were held. It's been a struggle with all three, but we're making progress on the two. We're hitting a wall with the principal, what they call the IRT.
As we say today, it's a hot mess.
Okay.
We'll get there.
And then one final thing, different subject. And maybe, I don't know if Tim is back there, he can answer, but he said that there seemed to be a chance that the air conditioning and air handler unit could fall through the roof if something bad happened at Mccrory's.
Mccrory.
And he said, I thought he said that could cause the whole building to collapse, but I don't.
No, I think he distinctly said that he did not think that the building was at risk of collapsing. Is that correct?
Tim, I think.
While we're waiting for the chief, I'm really glad that in your pictures of investments, the Mccrory building was left out of that page.
That will not be a part of the real estate allocation.
Thank you. I feel much better now.
Could you talked about the possibility of the air conditioning and air handling unit on the top of Mccrory's falling through the roof, potentially?
Yeah, very much so.
And I thought you said, but I may be mistaken, that could cause the whole building to collapse?
No.
Oh, okay.
It'd just be an internal collapse.
Okay. Gotcha, that's all I need.
Either way, it would be a big mess, Bill.
But it wouldn't cause collapse out into the street
No.
or anything like that? Okay, that's all I have, thank you.
Thank you, Bill.
Thanks, Bill.
Amanda, do you have any questions?
No, I don't.
Okay, thank you. Meeting's adjourned.
Thank you.